Every year, entrepreneurs overspend on taxes without even realizing it. I'm going to show you a few lesser known tricks to avoid taxes that even the most experienced business owners don't seem to be catching up on. I'm Grady Cool, CEO of Cool Wealth Management. I help business owners make better investment decisions. First, we can make the most of your retirement contributions by doing a mega Roth backdoor with your 401k. Roth contributions are post-income tax and often more beneficial than a traditional contribution into a pre-tax account like a 401k. That's because Roth contributions come out tax-free. There are two sides to a 401k. Employer contributions and employee contributions. It's a little confusing, but it's about to get worse. You can make Roth contributions to the employee side, but not the employer side. This is where the backdoor strategy comes in. Once the employer side contributions, the pre-tax side of a 401k, is rolled over into a traditional IRA, which is a pre-tax account, the traditional IRA can then be converted into a Roth IRA, thus now being in a post-tax account that can grow tax-free and then be taken out tax-free. This gets around the annual 7K contribution limit for IRAs and Roth IRAs, as well as the income limitations around Roth IRAs. Combining these two strategies of the Roth 401k and then the backdoor side of things, you're able to get Roth contributions with all of your retirement contributions. The rules around when you can roll over a 401k into a traditional IRA can get a little tricky, especially with income bracket timing. Meaning if you're making a lot of money and then you convert and you have to pay a bunch of taxes in terms of income taxes that year, when you do the conversion, it's where a lot of entrepreneurs can struggle. Finding the right timing is essential with this first tip. My next tip is around accelerated depreciation. Most long-term assets, property, or equipment is generally capitalized over a long time period. What that means is you write it off over the whole 30-year life of how you own the asset.
Old Bessie here still rocking after 15 years.
While it is nice to have that year after year, it's not as nice as having the money right now because money is more valuable to be reinvested back into the business today. Section 179 of the tax code lets you write off most tangible business assets, including equipment, furniture, and software if it is below $1,260,000 with phase outs up to $3,150,000. By expensing assets immediately, your tax bill for this year will be much lower, and then you will have money to either put back into the business or just have a little fun or a much needed vacation. The next one is for those of you who specifically own your own office space or building. Commercial real estate can be a great opportunity for additional tax savings. Normally, when you buy commercial real estate, the IRS says you have to depreciate it over 39 years. By segregating costs, you can actually cut down the number of years on a lot of different pieces of the overall property. We just talked about how expensing things sooner can save you a lot of money on taxes that you can reinvest. Cost segregation lets you label specific lives of specific items within the building. This includes things like the carpet, the lighting, your HVAC system, things outside like gardening. There's a bunch of different examples, but I hope you get the idea. Each of these items may only have a life of 5, 10, or 15 years. That's a lot sooner than 39 years. That means you can expense those items sooner and get the tax benefits a lot sooner as well. Because this process can take a little bit extra work, it's usually only worth it if your property is worth at least $500,000. But a lot of commercial properties cost a little bit more, so this usually applies to most people. My last tip is a little bit controversial, but when done above board, can be a legitimate way to save some money on taxes. Leveraging deductions for hiring your family. You can have your spouse, children, or any other financial dependent be an employee of your business. As an employee, you can pay them. By paying them, you are increasing your business expenses, thus lowering your taxes for the year. If your children are under 18, their wages are exempt from Social Security and Medicare tax. Usually you aren't going to be paying your family members large sums of money because it's just not that believable that you're paying a child to do that much work. That means you can typically apply the standard deduction to their income, thus lowering your personal income taxes for the year. There does need to be a legitimate business reason for hiring and paying somebody. You can't hire a 7-year-old to be your software engineer and then pay him $300 an hour. You also can't pay little Timmy $1,000 to sweep floors. Make sure when you are setting this up, if you were ever to be audited, it is fully believable and that there is a legitimate reason for why you are paying them what you are paying them. These are just a few of the tax tips I use with entrepreneurs every day. If you have any questions about your particular situation, feel free to comment down below. If you would like help with a free investment proposal, click the link in the description to schedule a time and I'd be happy to work with you. Other than that, I hope you have a good one and I will see you in the next one. Bye!